welcome back to the Investor Coaching TV show. We're talking about the investment vortex, which is it's a model to see what a portfolio might do in any given year, or a 5-year period, a 10-year period, 20-year period. A lot of people, when they invest, they don't know what to expect. They invest, they hear about a fund that's done well in the past, and guess what? The investment advisor's all about it, telling you about how well they've done in the short-term past. That's how they get you to invest with them. Or a mutual fund company does this all the time. What they'll do is they say, hey, look, here's our 5-year track record, our 10-year track record. And what ends up happening, you invest and let's say that it doesn't do what you thought it would do or what it did in the past. Then what do? You go, oh, I'm out of here. This fund didn't do what I thought it would do. Setting proper expectations is a huge step in making sure that you stay disciplined and that you don't sabotage your investment portfolio and that you end up getting the results that you want out of your investments. So we just talked about 4 different models: a conservative model, a moderate model, a growth model, and an aggressive model. Let's just revisit this for just a quick second, shall we? And we're going to take a look at these 4 models again very quickly. And then what we're going to do is we're going to look at the vortex for each one of these models. Step 1, the conservative mix. Remember, this is the 75% bond mix. If I look at this portfolio, it would have the lowest expected return of the 4 different models. We see that after expenses, an assumed expense of 2%, my expected return from 1973 until today is about 7% per year. That's the return of that particular portfolio. Now you see these 2 lines above and below? That's the vortex. In other words, if I hold this portfolio for 1 year, right here, see this 1? That tells me that I might have a 24% return in this portfolio, or I might lose 4% of my money. This is with a 95% confidence level. In other words, if I'm a betting guy and I want to bet what my return might be over the next calendar year, I'd have a 95% chance of winning that bet if I took a guess that it would be somewhere between this right here, around 24, and around -4. Now, my expected return is 7.14%. Here's the thing to keep in mind. My returns would probably fall in between these 2 things. So if they do fall in between those 2 numbers, then everything happened the way it should. But what I want you to realize here is notice how it starts to close in as we get further over to the right. In other words, the more years that I hold this portfolio, the more I close in on the expected return of the portfolio. If I hold this portfolio for 1 year, I might have a return of -5%, -4, -5%. My return might be as high as 20%. Here's how academics view risk. An academic would look at this and go, oh, you know what, Mr. Investor, you might have a risk of a 20% return in this particular portfolio. Now, we don't look at risk that way, do we? No, we look at it and go, whoa, what's my risk of losing 5% of my money in a given year? That's how we view risk. Academics view risk as just not knowing what the return is going to be. So with a 95% confidence level, again, my return might be as high as 20% or as low as -5. If I hold the portfolio for 5 years, however, what happens to my negative? It comes way up. I might, with a 95% confidence level, I could have a 5-year period where I have a -0.9% return. It would be pretty rare, but it could happen is the point. I might have a risk of a 15% return. It'd be great, wouldn't it? But, what we're seeing there is a pretty rare instance as well, as you're going to get a feel for in a second here. If I hold the portfolio for 10 years, I might only have a 0.06% return, or I might have a 14% return per year. Again, very rare on either one. My return is probably going to be a little bit closer to the expected return that we talked about earlier, which is, let me go back to that for a second, 7.14%, okay? If I hold it for 15 years, my bottom end comes up, my top end comes down. And if I hold it for 20 years, my bottom end comes way up and my top end comes down again. So I close in on that expected return. Now, what if I have a moderate mix? Half stocks and half fixed income. What are my expectations with this particular portfolio? Well, if I look through time, what I see is that I have a higher expected return. 8.64% is my expected return, which is higher than it was under the conservative portfolio. Now again, what do we have? We have a wider vortex, and you'll see that in just a second. I could have a risk, if I hold this portfolio for 1 year, I could have a risk of losing 12% of my money. We view that as risk. I could also have a risk of making 29%. We don't really view that as a risk, do we? If I hold this portfolio for 5 years, what's my low end risk? Negative 1.76. Top end, I might make 19% per year. Oh, happy day if that happens, right? 10 years, you see the bottom comes up, the top comes down some. And if I hold this portfolio for 15 years, again, my worst case scenario, 95% confidence level, 1.6% per year, 15.6%. 20 years, 3 and 14. You see how this works? What happens is I hold this portfolio, I end up closing in on that expected return. Now a growth mix right here, and I'm actually going to show you real world numbers right now. This is kind of interesting. I was working on this quite a while this morning, and this is a growth mix. This is 75% stock, 25% fixed income. And you see the vortex right here, the width, it's a lot wider than the other previous two, right? Now I'm going to get to what all those black dots are in there in just a second. What I did is I went and looked at over the last from 1973. Now realize in 1973 there was a pretty big market decline, and in 1974 there was a pretty big market decline. So that's why I went back to 1973 with this particular model. If I held this portfolio, my expected return is just shy of 10% per year. That means that money doubles around every 7 years historically. If I hold this portfolio and I look at what was the best year, well, the best year was 1975, and the rate of return was somewhere in the neighborhood of 42% that particular year. I had a risk of a 42, so that was just above the vortex, wasn't it? So I can actually have returns that are outside a little bit of the vortex, historically speaking. Now, if I look at the next best year, it was 1985, which was right at the top of the vortex right here. If I look at the next best year, it was 1986, okay? Now, let's take a look at the 3 worst years with this particular model. And maybe some of you can guess which one of the 3 worst years was. If you guessed 2008, you nailed it. Right here, this portfolio would have gone down about 27-28% in that particular year. If I look at the next worst year, it was 1974 at about a negative, it looks like to be about a negative 15% return right there. And 1973 was right behind it at about a negative 9, negative 10% return. Now, the other years, of course, as you would expect, the returns would be spread between those extremes. So most of my returns would be right in here, right? I had a few stray returns that were above, much higher return, and a few stray returns that were below the vortex. But most of my returns, 1-year returns, if I held this portfolio for 1 year, would have been in between. Now, what if I go out to 10 years and I say, well, what were my rolling 10-year returns? If I held this portfolio for 10 years, and remember the time horizon of this portfolio is 6 to 9 years. If I need all my money back in 6 to 9 years, then what I want to do is this portfolio, I could have this portfolio and reasonably not be expected to lose money over 6 to 9 years. If I look at all my 10-year returns, it's right there. And what do you notice, folks? Going back to 1973, all of my 10-year returns are in between and inside the vortex. Every single one of them, see, right here, has been in between, and our worst return was right here. Our best returns were up here. So did the portfolio do what I expected it to do? The answer is yes, it did. It fell within expectations. When it falls within expectations, I can just go, oh, okay, everything's going the way it ought to be going, and I can relax. Next, what we're going to do after this break, we're going to look at the aggressive portfolio. The long-term portfolio. For those of you that are younger, maybe in your 20s or 30s or maybe even early 40s, hey, I'm 48 and I actually have all of my money in an aggressive portfolio. We're going to look at what you might expect out of an all-stock aggressive portfolio. And we'll do that right after this on the Investor Coaching TV show.